Hello everyone, welcome to chapter 12. This chapter is going to be all about the open high low close or the open low high close concept. Now, this is one of the most underrated concepts when it comes to ICT or CRT trading, but I almost use it every single time when I'm doing my pre-session analysis or when I'm trading, right? In this chapter, we're gonna break down everything about the open high low close concept, and we're gonna discuss how you can use it to assist you in your trading and your analysis. After watching this chapter, you're going to be fully equipped about its details and intricacies, and you won't need anything else apart from it about this particular concept. We're going to discuss what it is and how you're going to be using it in your analysis to assist you. Alright, let's move on to the next slide and let's discuss what open high low close is. So, as most of all already knows, it basically stands for open high low and close in case of OHLC, and similarly in case of OLHC or a bullish candle, it stands for open low high and close, right? This concept is a bit familiar to market profiles, intraday profiles, and weekly profiles, and has certain characteristics similar to those concepts, right? Because they've got the same underlying core concept, right? The core concept for all of them is the same, right? Just like with intraday profiles, we use them to break down a daily candle into different segments. And the same way, we're going to use open high low close or open low high close to break down candles on any single time frame, right? In the same manner, with a lot more details, which will have its own opening and closing times as well, right? We're going to discuss this all. Similarly, you might remember that market profile. With market profile, we built our fundamental understanding around how price generally moves, right? And we use it all the time in our analysis, right? But we know that market profiles lacks framework in terms of providing time aspects or price ranges, right? That's why we make sure to always use market profiles in conjunction with key levels and dealing ranges so that it offers us a framework and we can work within that framework. Now, with the open high low close or open low high close, we're going to use the same market profiles on a micro level with its own logical framework, while at the same time combining with key levels or higher time frame key levels, right? So, in summary, open high low close is used to break down a single candle into multiple dynamic phases and sequences, right? And it can be done on any single asset or any single time frame, right? It doesn't matter because after all, it's fractal. Now, the reason open high low close is more advanced than intraday or weekly profiles is due to the fact that not only it provides its own framework, but also it has opening and closing times to it, which gives it its own time aspect, right? Which makes it easier for us to gauge through and measure price, right? That's the most important thing about this concept. Now, with opening and closing times, it becomes easier for us to expect market profiles at the right place and at the right time, right? And we can easily gauge through and measure through price when we have those two aspects, the opening time and closing times. And we know for each and every single candle, we've got those two factors already, right? It's a fundamental part of a candle. So when we are breaking down a candle with open, high, low, close, it's a lot easier for us to break down the whole candle into multiple phases or sequences. We're going to discuss what are the different sequences in a minute, but let's discuss what open, high, low, close is in a more refined manner. Now, the most important thing about OHLC or open, high, low, close is that it helps in the development of our anticipatory skills, right? And what I mean by that is with the help of this concept, you're gonna finally have a filter which will help you stay in or stay out of the markets, right? Meaning it's gonna give you a filter with the help of which you're gonna be able to differentiate between high probability conditions or low probability condition, right? With this perspective, you're gonna be finally able to gauge between the two types of conditions, and you're gonna be able to make more refined and more conductive and critical decision whether you wanna engage with the markets or whether you don't want to, right? And you're gonna do that with the help of this concept. Now, it will tell you, or basically, you'll be able to tell whether you want to approach the markets at a specific time or at a specific price or not, right? Or you just want to stay risk off. You're going to be able to do that with this concept. Now, it will not only help you with the first few things that I mentioned, but this one too, which is kind of the most important in my opinion, right? It will help you build your anticipatory skills. That's one of the most important thing about this concept, and why I deem it as a significant concept, right? Because of this particular part. We're going to discuss this part even more in the last part of the chapter, but let's get over. Now, all of these chapters, just as I said before, are designed in a way so that I'm introducing you to each one of these concepts in a logical manner, right? And I'm making sure that you are being equipped with the right knowledge at the right time, right? I don't want to give you any concept or anything at the wrong time, right? Because that is going to cause either overwhelming or underwhelming for you. And I want to make sure that everything is balanced so that you're getting your knowledge at the right time, right? That's because it has to be balanced, right? You can't overdo it or underdo it, right? There's both of them are gonna cause um, troubles for you, but when you make sure that you are learning it properly, right, and you're getting all of this knowledge at the right time, with also being shown how you can use it in live markets through the help of these breakdowns, all of those things together will make sure that you are fairly being equipped with the right knowledge, right? So, and that's exactly my goal with CPI. Now, as I said before, every one of these new concepts are connected with the latter ones, right, that we discussed before in the latter chapters, and they'll all be used in conjunction with each other. It's the predominant theme of CPI. It has always been like this, and it will stay to be like this, right? So, open high low close is used as a framework for accurately and precisely understanding how market maker influences ranges, expansions, or reversals in the market, right? And how do the market movement occurs and what factors influences them, right? And most importantly, how you can catch them, how you can exploit them. That's the most important part. Now, let's move on to the next slide and let's discuss some important things regarding open high low close or open low high close. The first important thing is that it will help us in building our price anticipatory skills, right? In the most refined way possible. We're going to discuss this later in the chapter. Second thing is that it will help us build a perspective that is predominantly based on liquidity. What I mean by that is that you'll dump the idea of pattern trading and you start looking at the markets with a logical perspective in terms of liquidity, right? You'll know how liquidity is generated, how it's purged, when it's purged, and most importantly, how you could exploit that perspective in your analysis, right? You're going to be able to do that with this concept. The three main aspects of this liquidity based perspective are knowing what engineering liquidity means, where does it happen, how does it happen, and exactly why does it happen, right? It could also be referred to as the accumulation of liquidity, right, or open interest. So you must know that what engineering liquidity means and how does it happen. The next thing that you need to know is that how liquidity is purged, right? What we mean by purging liquidity or manipulating liquidity, right? You need to know that as well. And the next one is the neutralizing of liquidity or liquidity being neutralized, right? Neutralizing of liquidity is done in two sequences, right? First of all, the purging and manipulating liquidity by taking it out, right? And then having a distribution or expansion in the opposite direction, and neutralizing and balancing out the liquidity by having a range expansion or by having a distribution, right? Towards the drawn liquidity, towards the higher time frame drawn liquidity, right? So you need to remember that. The third one is order pairing, right? And this will help you understand why all of the above happens and what liquidity actually is, right? Order pairing will help you understand liquidity even more. Then last but not least, we're going to use all of these in conjunction with market profiles, key levels, dealing ranges, and so on, right? Moving on, right here you can see these two candles, right? These are the classic buy and the classic sell candles. Now, your job as a trader is to catch one of these candles either throughout the week or throughout the day, right? So if you're trading the weekly candle or you are a swing trader, right, then your job would be to catch at least one of these candles throughout the week on the daily time frame. And similarly, if you are an intraday trader, then your job would be to at least catch one of these classic buy or classic send candles on the 4 hour time frame. And obviously, you're going to trade that on the 15-minute time frame. Uh, these are the types of candles and the classic buy and sell candles where you're gonna find most of your trading opportunities and trading ideas, right? Because after all, your job is to catch expansions and stay out of the ranges or retracements. Now, before the candle forms, you won't know if it's gonna be a classic buy or sell candle, like right? But there are certain factors which are going to help you filter out market conditions and help you accurately gauge expansion candle like these, right? We're going to discuss this in this chapter. Now, we all know how a candle works and how does it form, right? First, we've got the open of the candle where the candle opens at a specific time of the day at a definite time. And then after that, either we form a high or a low, and then after that, we expand towards the opposite direction uh, in which we form the opposing high or low, right? And then it closes at a definite and specific time. That's what a candle is, right? That's basically how a candle forms in a nutshell. We all know that, right? But what makes this concept so interesting and helpful is the fact that you can use these simple details to integrate market profiles and key levels with it, and those concepts together will help you determine and predict where the high and the low of the candle will be formed and where the candle is gonna close and where could it potentially be headed to, right? That's what trading is about. Knowing and anticipating where the next candle is gonna close and where can it expand to. And you're gonna be able to do that more accurately and precisely with the help of this concept. You'll be able to know at what time you're gonna take your entry and at which times you're gonna stay out or stay risk off away from the charts. These simple details will give you filters and protocols for finding trade ideas or simply just staying risk off. Now, right here, just with these graphics, you can't really see the whole details and insight into this candle, right? But single candle, when divided on the lower time frame, has multiple sequences and phases, which leads to the formation of this single candle as a whole on the higher time frame. Now, of course, you're going to be trading this on the lower time frame, so your objective would be to accurately predict and anticipate the open high low close sequences of a higher time frame candle and then trade it on its respective lower time frame based on time frame alignment and time frame selection, right? That's up to you. This is how they work in a nutshell, right? Now let's move on to the next slide to discuss each one of these candles in great detail. So right here you can see that we've got this classic buy candle or this classic buy side expansion candle, right? Now it looks sweet and cherries in hindsight, but we're gonna discuss it different intricacies and phases, and we're gonna discuss how it actually forms and how does it forms, right? We're gonna discuss each of those sequences or phases. So we all know that each candle has a specific, definite, and constant opening time, right? That opening time cannot be changed and it stays constant all the time, right? Now before we move further, you must remember that you're going to make sure to combine and integrate this particular concept with the other concepts like the dealing ranges, the key levels, and only then you're going to have to deal with this and you're going to be able to integrate and incorporate and apply this concept accurately, right? If you're just going to use it alone, then obviously it won't help, right? All of these concepts have to be used in a logical framework, and only then you're going to have a higher precision and accuracy, right? So let's say you've determined that your higher time frame down liquidity is higher and you've got a key level right here, right below you, and price has opened right here. We've got a key level below us and the ground liquidity is higher. You've determined that on the higher time frame with the help of all of those other concepts, and you've determined the ground liquidity is higher. Now with the help of this concept, we're gonna divide the whole candle into multiple segments, and we're gonna see how we could have exploited this candle right here on the lower time frame, right? That's what your background base and framework is going to be. Ground liquidity is higher and we've got a key level below us, below the opening of the candle, right? As I said before, you're going to make sure that you already have the whole framework for the higher time frame down liquidity and buys before you analyze the charts with this concept, the open high low close or the open low high close concept, right? So coming back to the main topic, right here you can see that the candle has opened right here, and let's say the candle hasn't done any of this, right? It's just open, right? It opened just now right here, and we've got a key level below us, right? And the drawn liquidity is higher. Then based off of these factors, what is going to happen is that more often than not, what is going to happen is that first of all, price is going to form a ranging profile or a range just above the key level at around the opening price, and it's going to do that for one thing, that is to generate liquidity or to accumulate liquidity or to accumulate open interest, right? The market moves either to generate liquidity, to take out liquidity, or to neutralize liquidity. These are the only things that the market moves for. If there's no liquidity, then the market won't move. The market moves from one place to another because it either wants to go and hunt or purchase liquidity or to manipulate liquidity, or either it expands and distributes to neutralize liquidity, or it forms a range to generate or accumulate liquidity, right? These are the three main aspects of every single market, right? Every single financial market. So whenever a candle opens, it always starts off with generating liquidity or accumulating liquidity, and that's always the first thing price does, right? That's why every time when you see that a candle opens or the market opens on Monday or any other single candle opens, more often than not you're going to see that it forms a range there, right? It forms a range there, and it immediately goes into a ranging profile, right? And for the first half of the day or the first quarter of the day, it literally ranges, right? And it does that to, first of all, to generate liquidity or to generate open interest, right? Similarly, when the month starts or the monthly candle opens, it spends like the first week to basically generate liquidity for the rest of the month for monthly expansion or monthly range expansion. Similarly, we know that when a 4-hour candle opens, the first hour is more often than not spent on generating liquidity in the form of forming a range, right? And it usually ranges at the opening time. That's what you need to remember. So when you know this and you're aware of it, then you're always going to be cautious around the opening time, and right, and you're going to make sure to stay away from the charts at that time, because you know that price is more likely is going to form a range, and your objective is to only catch expansion, right, and stay away from ranges. So you're going to use that factor and use that fact as a filter to differentiate between lower probability conditions and higher probability conditions, and you know that a ranging profile or a range is a lower probability condition for you, so you're going to stay away from the charts at the uh, at the start of the opening time or whenever liquidity is being generated, right, above a key level or below a key level, right? And that is the exact reason why we usually skip Monday, because we know that it's highly likely that price could range for the first day to generate liquidity, so it's better to just stay risk off and stay away from the charts instead of messing with the markets, right? And then we trade that Monday's range the rest of the week, and we use that Monday's range to have range expansions or to distribute higher or lower. Now, obviously you have to remember that this isn't what happens all the time, right? There's going to be certain times where price expands right away, but that happens like really rarely and only in rare cases, right? So you also must be cautious about that as well, and I'm going to taught you that as well, right? How you can catch those sorts of expansions, and I'm going to also tell you why exactly that happens, right? We're going to discuss that. But what you need to remember is that most of the time, or more often than not, price forms a range to generate liquidity at the start of the opening of the candle or right around the opening time, opening price, right? Now, when we've generated enough liquidity for the market makers and it's ready to expand or distribute, first of all, it has to purge the liquidity, right? or simply take out or manipulate the liquidity. And with that, it's going to do two things. First of all, during the manipulation profile, it's going to test the higher time frame key level, and second, it's going to rebalance a dealing range, right, or an expansion swing or a higher time frame. These are the two things that it will do after liquidity is generated and then it's purged, right? Whenever we have a manipulation profile, that manipulation profile does two things. It first of all purges the liquidity that we generated earlier, and second of all, it rebalances a dealing range or an expansion swing on the higher time frame, right? Whenever you see a manipulation profile and you backtest those things, you're gonna see that it always do these two things, right? So you can note these two things down. With this purging or manipulation of liquidity, price forms the low of the candle or the high of the candle by testing the higher time frame key level and rebalancing the range. In this case, we've got a classic buy candle. So with this manipulation of liquidity, price forms the low of the candle by testing the higher time frame key level, which is below us, right? But now you can see that we've generated liquidity. First of all, we generated liquidity and now we've purged it, right? But now you can see that the liquidity has to now be neutralized because we are at a market imbalance. The liquidity is imbalanced, right? Because it was first generated and now it is being purged only on one side. So it is an imbalanced state of liquidity, right? And now it has to be neutralized and rebalanced. And that happens in the form of an expansion or distribution in the opposite direction, right? Or in the direction of the higher time frame drawn liquidity. For that neutralizing of liquidity, we expand toward the higher time frame drawn liquidity, and more often than not, we reach the opposing drawn liquidity or higher time frame key level close to the closing time of the candle, right? And with that, we finally form the high of the candle, and that results in the candle's range being capped, right? And then the candle closes, right? And that's basically the whole cycle of our candle forms, right? With that, we form the high of the candle and then we close the candle, and the close of the candle acts as a reset for resetting the whole cycle, and then a new cycle starts with the next candle repeating the same cycle over and over again, right? That's what happens every single candle, right? Generating liquidity, purging liquidity, and then neutralizing liquidity, right? And then last but not least, resetting the whole cycle by closing the candle, and then the same cycle repeats as soon as the next candle opens, right? That's basically how each candle is formed, and each candle works through the help of liquidity being generated, purged, or neutralized, right? This is basically how the market moves, and you should be aware of this. Now let's repeat it once again. Opening time acts as a generation of liquidity or forming a range. The low is found after the manipulation into key level, and that is done to purge the liquidity which was generated earlier. After that liquidity is being purged and it's purged, we neutralize the liquidity by expanding above in the direction of the higher time frame drawn liquidity, and then price retrace close to the closing time, and then the closing time acts as a reset for the whole cycle to repeat itself, right? The closing time closes the candle and resets the whole cycle or the whole sequence.